Now, at the most basic level, equity markets reflect the balance between growth expectations and financial conditions. If you're earning in excess of your cost of capital, the stock should trade above its book value. Now, the shape of the yield curve, i.e. the difference between long-end rates, e.g. 10-year Treasury bonds, and short-end rates, e.g. 2-year Treasury notes, is also sending the market a message on growth expectations versus financial conditions. Now, the long end of the curve is often interpreted as a barometer on medium-term growth expectations. If 10-year yields are rising, all else equal, growth expectations are rising, while the short end is reflective of current financial conditions. If 2-year yields are rising, all else equal, monetary policy is likely tightening. So let's first make the distinction between flattening and steepening. Now, if short-end rates are rising faster than long-end rates, the curve is flattening. This is what we've seen for most of the period since mid-2021, with rate markets anticipating tighter monetary policy. Now, the curve can also flatten, however, when long-end rates are falling faster than short-end rates. So there is a distinction to be made whether the flattening is short-end led or long-end led. If long-end rates are rising faster than short-end rates, the curve is long-end led steepening. This could be due to current policy rates remaining low and we are coming out of a recession. Alternatively, more bearishly, the curve can steepen when short-end rates are being cut into an economic downturn. In terms of the terminology, markets typically refer to 4 phases. Let's start with bear steepening. When we are exiting a recession and we can see signs of a recovery, the long end will rise while policy rates remain low. This is long end led steepening. Moving to bear flattening. Now there's signs of overheating and policy rates start to normalize. So here, the short end rate of the curve rises faster than the long end. This is short end led flattening. Then bull flattening. Policy rates now remain steady, but long end yields start to falter as possibly the market is feeling the lagged impacts of monetary policy, or simply there are concerns about medium-term economic growth. This is long end led flattening. And then finally into bull steepening. Rising expectation here of an economic downturn which sees short end rates fall faster than long end rates, with policy rates likely cut.